The more that I help people with real estate, the more I realize that this one specific thing is not particularly clear to people, especially first-time home buyers, and that is, what is FHA, what is conventional, and which one should I use? Again, my name is Jesse Lynch, and I have two big passions that I put out on this channel, and that is basically all things real estate, all things learning about real estate, the ins and outs of real estate, and showing off this amazing place that I live, the Twin Cities of Minnesota. Today we're talking about two things: FHA, conventional, what are they, what should you use, etc. Let's do it. Really quick disclaimer, I'm not a lawyer, I'm not a mortgage broker, I'm not a mortgage or finance professional, I'm a real estate agent. Real estate is what I know, but I happen to witness a lot of this kind of thing in real estate, and so this will help you along your way. But when it comes time to actually buy, you gotta use a mortgage professional. And if you reach out to me, I'm gonna make you use a mortgage professional, as well as any real estate agent should. Okay, so first things first, you might be wondering, so why are we only talking about FHA and conventional? There are other types of loans, right? Yes, there are other types of loans, but these two loans are the most broadly qualifiable loans out there. If you're looking for a down payment assistance program, most often they're going to be attached or aligned with a conventional or FHA loan. Okay, when you think about FHA, I just want you to, in your head, think about the government. F stands for federal, okay? So federal government, the United States government. When you think about conventional, I want you to think about investors. So whether that be companies, people, entities who lend their money out to make money off interest, and the federal government not necessarily involved. Okay, quick history on FHA. Partly because I think it's interesting, and partly because I think it's sort of useful to know why it works, and down the road you might be able to think about things a little bit differently. FHA officially became part of HUD in 1934. What's HUD? HUD is the Department of Housing and Urban Development. Housing, Urban Development, HUD, HUD. So in 1934, the Congress created FHA, the Federal Housing Administration. And when FHA was created, the economy was a wreck. The housing market was a mess. Back in 1934, 2 million construction workers had lost their jobs. And maybe that doesn't seem like as much right now, but think about what the population of the United States was in 1934. A lot lower than it is right now. And because the economy was in such shambles, mortgage lenders didn't really want to lend out money because it was so risky. And so qualifying for a mortgage was extremely, extremely difficult. The nation was a nation of renters. Only 40% of households had somebody who owned the house living there. That's pretty crazy when you think about in 2001, 68% of people owned their house. Okay, so that's a huge jump. In the 50s, 60s, and 70s, the FHA was doing stuff like making apartment homes for the elderly, disabled, low-income housing, that kind of thing. And that was through the 50s, 60s, and 70s. And then in the 80s, when there was another market crash, FHA stepped in when private mortgage insurers stepped out because it was too risky for them. They were like, we're not going to insure these loans when the market is dropping. So FHA stepped in and said, okay, we will insure these loans, which then made more home loans available to homeowners. And ultimately, FHA really helped prop up the home market during the recession in the 80s. And again, they did the same thing after the Great Recession in 2007, 2011. They really propped up home ownership by insuring, somewhat riskier loans in a riskier time. And they really helped more people. Fundamentally, for our purposes, is like an insurance program for these loans. And what that means is you can be a riskier home buyer and you can still get a home loan insured by FHA for a very low interest rate and a very, very low down payment. And if you've already watched my other video on how can I afford a mortgage, you know that FHA, fundamentally, there's a few things they look at. Your credit score. Truly, for the sake of simplicity, the minimum credit score for an FHA is 580. The optimal credit score for FHA is going to be anything above 640, and you're going to be able to get the best interest rate offered by an FHA loan. The minimum credit score for an FHA loan is 3.5%. Which is super low. And I will say that if you go up in percentage down, it doesn't necessarily improve your interest rate. So that being said, there's not really a reason to do a 5% down FHA other than it'll kind of lower your principal and ultimately long term make you be paying a little bit less. But if you're talking a 3.5% down versus a 5% down, there might not be that much of a reason. Again, ask your lender about that, but I do believe that having cash on hand is really important. If you can get into a house for 3.5 down and then have another 1.5% available to you, that money can do more work for you than you save by putting it down. 3.5%, hopefully you could put that in the stock market and make more than 3.5% in a year off of that same amount of money. Understood? I hope so. Another stipulation of FHA is that it is intended to be the main residence of the person who's taking that loan out, and it is supposed to be homesteaded, or it is supposed to be the primary residence. You can't get an FHA loan on a vacation home, okay? The FHA loan is for the primary residence. You can eventually move out of it, but you're supposed to live in it for a year. I think if there are other wild factors, you're not going to get in trouble if for some emergency reason you had to move. But nonetheless, that is the intent of the FHA loan, is for it to be lived in by the person who has the loan taken out of it. Okay, and finally, the last part of it, which I would say is the biggest negative of an FHA loan, potentially, stick around, you'll kind of see why I say potentially, is mortgage insurance, or you might see it as PMI if you're looking on websites or whatever. PMI just means private mortgage insurance. Mortgage insurance fundamentally is something that you pay every month to a mortgage insurance company. And I don't mean FHA, it's weird. There's FHA, which is insurance, and then there's private mortgage insurance, which is another thing, and you pay to them every month, and what that does is it limits the liability. That way, if you stop making payments on your loan, that mortgage insurance company will then step in and make the lender whole and limit their risk. And the reason that it's a negative with FHA is because with FHA, it stays forever. It is attached to that loan forever until that loan is paid off. So even if out of a 30-year loan, you're in your 29th year, and now your house is worth $100,000 more than it was when you bought it, and you hardly owe any money at all, doesn't matter, you're still paying that PMI. And I will touch on the mortgage insurance part for the conventional in just a second. So conventional, I said I want you to think about investors, okay? And I don't just mean an individual who's putting some of their paycheck on Robinhood. I mean bigwig investors and companies, entities, and rich people who loan their money out to make interest, to make money on that money. And so they're not backed by FHA, and thusly they want you to be a lower risk. And if they loan to you as a higher risk person, and still there are minimum limits for how risky you can be, and I will touch on that, but because they are lending on your risk profile, if you're higher risk, you're going to pay more. One of the biggest myths that I hear all the time about a conventional loan is that you need 20% down. That is not the case. If you've watched a bunch of my other videos, you probably know that's not the case, but if this is the first video you're watching, newsflash, 20% down is not the minimum down payment for a conventional loan. Maybe it was at one point, but it certainly is not the case now. I will say that it is the minimum down payment for a conventional loan to get the best terms with a conventional loan. But you can do a 3% down conventional loan, which is even lower than FHA. You can do 5%, 10%, 15%. And I do believe that as you begin to go up in those chunks, then the rates will get better, the terms will get a little bit better. But that being said, if you can do a 3% or 5%, then maybe you'll get a little bit better terms with 5%. If you can do 5% or an 8%, the terms will be the same. Once you get up to that 10%, then maybe you'll be at a better term. And then again, 15 and 20. But in between those steps, you don't necessarily get a better term. So for sure, that should be a question for your lender. If you're like, oh, I can maybe scratch up an extra $3,000, does that improve my chances or my terms? Probably not, unless you're doing something like buying points down or something like that. Maybe that would be a better use of your money. In that situation, ask a mortgage lender. And for the record, the 3 and 5% conventional loans often are only intended for first-time home buyers, and almost for sure only for property that you're going to live in. Okay, you can't get an investment property with a 3 or 5% down conventional, and you also can't get 3 vacation homes with that little down. Don't quote me on this. I think you can get your first vacation home, which sounds like a nice issue to have more than one vacation home, but I believe you can get your first vacation home, so like a cabin or something, with a 10% down loan. But again, it sort of has to be like your secondary home. It can't necessarily be like a rental or an investment property. I don't know. Also, another question for your mortgage lender. Okay, and then again, if you watch my other videos, you know that the minimum credit score for a conventional loan is somewhere right around 650, but just because you can squeak into that 650 minimum credit score for a conventional doesn't mean that you should get a conventional, because the cool thing about FHA is once you qualify, if you're at 580 and they'll qualify you, maybe there'll be penalties. So if you're at 600 and you qualify for an FHA, it doesn't benefit you to have a higher credit score. You're not going to get better terms. Once you're in, if that makes sense. Conventional, not the case. The higher your credit score, the better your financial picture, the better the rates are going to be. So if you have immaculate credit, then maybe conventional is the move for you. But again, this is probably going to be the last time I say this. Ask a lender, okay? But this is general pictures. I can't give you guarantees. I can't give you solid numbers necessarily. For one, because I'm not licensed. Two, because it's illegal. Three, because it changes all the time. So if you're watching this in 6 months from now, it might be slightly different. And so I don't want to promise you anything. I don't want to break your heart. And I also don't want to lie to you. Okay, now, remember earlier when I was talking about the mortgage insurance with the FHA loan? Okay. And I said, I'll talk about it on conventional. Anyways, that's right now. It's happening right now. Congratulations, you made it to this point. You probably understand these loans better than most people. Okay, what happens with a conventional loan and the mortgage insurance is you buy a conventional loan for 3% down, which means that the loan is 97% loan to value, which is pretty crazy. If it's a $100,000 house, the loan is $97,000 and whatever, you can scale that up accordingly. And on an FHA, you're going to be paying mortgage insurance through all the way to the end for that whole $100,000 that you're paying down. Okay. With a conventional, you get to stop paying that once you are at a 80% loan to value. Okay. So once basically you have 20% in equity. So what happens is, as you own a home, you buy the home, and over time, you're paying off the mortgage, and theoretically, most of the time, not always, you can also force that value to go up too by making improvements. And so if $100,000 house, and say the value stays the same, once you're at $80,000, boom, you're not paying mortgage insurance anymore. All of a sudden, you have like an extra $100 or whatever a month, because that's what you're paying in mortgage insurance. And likewise, if you buy that same house for $100,000, and in the first 6 months you update it and you make it beautiful, you can get it reappraised. And if you get it reappraised or reassessed and it's worth $120,000, then boom, you no longer have to pay that mortgage insurance. Whereas with an FHA, it doesn't matter how much you improve it, you're going to be paying that forever. Okay. So that's a huge factor when you're thinking about FHA versus conventional. But it is also worth considering if you buy a house that's in perfect shape, it's basically a flip, or it's like a brand new type of house, and you're only going to live in it for 3, 4, 5 years, well, it won't really matter, especially if you can get a cheaper rate with FHA. It won't matter that you're paying that private mortgage insurance, because for one, you're not going to be able to improve that house enough to get out of that mortgage insurance, and two, if you're going to sell it by 5 years, you're not going to be at 20% loan to value. Okay, it's a 30-year mortgage. You'd have to be 5+ years into that loan to be at 80% loan to value. Unless home prices skyrocket, of course. That could always happen. You never know. Does that make sense? I hope it does. The other big factor to consider when you're choosing FHA or conventional, and I don't hear enough people talk about this, but this is the truth, is the condition of the house that you're looking to buy. If you are purposefully trying to buy a fixer-upper, right, that it's a little junky, but I want to put in the work, I want to get the equity out of it, and I'm not afraid of doing that work, FHA can be tricky, because one thing that FHA has that conventional doesn't have the same sort of stringency on. Stringency, is that a word? Sounds like a word. But FHA is going to look at the quality of the house. They're going to look at the livability of the house. The last thing FHA wants to do is loan on a house that has something that won't allow you to live in it. Maybe the heater doesn't work. Maybe there's broken windows. Maybe it's not livable, because it's full of stuff. But then they also get down to these little details that are kind of annoying, to be honest, like peeling paint. Peeling paint is one of the biggest things that I run into with FHA. FHA doesn't like to loan on a house that has peeling paint, and the reason for that is lead paint. Before 1978, paint used to contain lead. Not all paint, but a lot of paint used to contain lead, and then that paint slowly chips or peels or cracks, And then I guess kids used to eat it because it was sweet. So I don't know, that's crazy, but that's the truth. That's what used to happen. So, and now because of that, FHA is like, no peeling paint, because they don't want to insure a loan on a house where that house is going to kill the people living there, right? A gas leak would be another thing. Another thing that they require all the time is smoke detectors and CO2 detectors. And just because the home doesn't have a smoke detector or CO2 detector doesn't mean that you can't still make an offer on it and still get the home. Potentially, you're going to make the seller put those things in. Or if the seller's like, nope, not going to do it, we're lazy and we don't want to spend $100, okay, then you can potentially do it yourself. And then lastly, there are a few loan products where if there's a certain amount of things that the FHA appraiser and the lender say, here's what has to be done for us to lend on this house. There are some loan products, and I will say they're a little bit evasive. They are hard to get. Not everywhere has them. But there are loan products where they will say, if you can close on this house on the closing date as specified, and we will give you 5 days to fix the problems, okay? So that being said, it can't be too big of a problem. It can't be a roof, right? It can't be, hey, the roof has to be fixed in 5 days. No way, not gonna happen. But it can be something like peeling paint around a window or no CO2 detectors, no smoke detectors. It can be that kind of thing. And as long as once you close in it, you get on it and you fix those things, then sweet. You can slide in to a home ownership with an FHA loan on a house that otherwise maybe wouldn't have passed. Okay, I'm gonna say this one more time. Ask a lender. Okay? The truth is, if you come and meet with me, which I hope you do, by the way, this is kind of crazy, but literally, like the minute that I began shooting this video, I got an email from a guy named Kevin. He reached out to me and said, hey, I saw you on YouTube, whatever. Interested in meeting with you, talk about real estate. So we're gonna meet up on Friday. That's why I do these videos, and that's why I hammer home every time I do a video, you gotta reach out to me. If you're looking for another agent, that's fine. But if you're just waiting on the sidelines, that's not fine. Actually, I just heard a quote the other day. I wish I knew who said it, but they said, even if you're on the right track, you're still gonna get run over if all you do is just sit there. Okay? So don't get run over. Get a hold of me, call, text, email, website, DM on Instagram, DM on Facebook, whatever you gotta do, handwritten letter, I don't care. Just reach out to me and let's get this thing moving. I hope this video was helpful. Do us both a favor. Subscribe to the channel, click the bell, like the video, leave a comment, and get a hold of me. All right, love you. Bye-bye.